But coming back to this, to the point that Jim was making, if Eaton does well, does that translate into employment for Ohio?
The answer is certainly yes.
No, not for the nation, yes, but for Ohio in particular is what I'm trying to focus on.
If Eaton does well, it translates into employment for Ohio.
Okay.
How much employment?
Okay.
We need a control. Never mind.
I think you've answered the question. Okay.
Good.
The failure of the international system, was it the failure of the regulators, or did they just get captured, as they often do, by the people they're regulating? And if that's the case, isn't a regulatory bill likely to run, any regulatory bill likely to run into the same problem, and we're likely to be back where we were in a few years?
Well, I think it's more than just the regulators or the examiners. It's the policymakers that have pushed policies onto the country that in part created the results that we saw. I mean, there's a lot of people that should aptly get blamed for this.
Let me rephrase your question.
Okay.
If the current legislation in Washington had been in place in 2001 or 2002, would the history of the 2007 to 2010 period be different? And the answer is almost certainly not.
Yes.
What happened during that period is that we had an extremely rapid growth of credit, and the Fed, for one or several reasons, did not understand what was happening in various product markets. It did not understand that essentially patterns of finance that were Ponzian were underway, and that at one stage it was inevitable that the credit available to these markets would stop and that asset prices would decline. So the problems that we associate with Goldman and Lehman and Wash, Mew and Countryside were made possible, so it became much more severe because the excessively rapid growth of credit that we had. We should not think of this credit problem in the U.S. context. We need to understand what was happening globally, because the same phenomena were happening in 5 other countries at more or less the same time.
All I would have to say, Charles, is that excrement happens. You run, and as life goes on, I follow a lot of pickup trucks on my daily commute to work. As you go through life, what ends up happening are tail events. No degree of regulation is going to suppress the, let's say, the urge to see and to seek out extraordinary returns, to extrapolate price trends that have gone on, to start regarding as axiomatic the fact that housing prices never fall. I mean, housing prices never fall, do they?
Apparently not.
I mean, I'm sorry. This is 2010, not 2006. I sort of missed my year. Okay, thank you.
Okay.
But let me just one further wrinkle. And when you look at the U.S. economy, it's probably 2 other economies, I mean, there is a natural tendency for this economy to produce bubbles. So we had a housing bubble in terms of overbuilding and pricing and the ease of credit.
A technology bubble.
And then you go back to 2000, year 2000, we had a stock market bubble and internet stocks. If you go further back in time, we've had emerging country debt bubbles, and we had highly leveraged transaction bubbles. And we've had, over the years, several bubbles every 10 or 15 years in commercial real estate. It's a natural tendency for our economy to overdo it.
So the City Club should pencil in at some time in the future a panel on the next bubble. Is that
That's
what
right.
you're saying? Okay.
For sure thing.
Okay.
I think we may need to make a distinction between the natural tendency of a market economy to produce bubbles and the inevitable tendency of the people in charge, the central bankers, essentially to ignore the question of the sustainability of what is happening in the markets for commercial real estate, of what is happening in the markets for residential real estate. When stock prices got to, in 1998, 1999, so high that the price-earnings ratio was 35 to 1. The Federal Reserve should have been asking, is this sustainable, or are there measures we can adopt to staunch the increase in prices? Questions of that sort should have been asked about the housing bubble that was developing. So yes, we can accept the inevitability of bubbles, but that does not mean that the Fed should take a hands-off view because it either can't measure the bubbles or because it's afraid of the political fallout if it tries to staunch the bubble before market forces lead to the pricking of the bubble.
But this, in fact, has been a long area of study and debate at the Federal Reserve. Again, you go back to the stock market asset price bubble. Suppose, well, you're seeing a bubble in asset prices, but your monetary aggregates are well behaved.
Yes.
Then this raises the question, well, what indicator should be your target? But they've asked this question, and they've backed off from addressing the asset bubbles in favor of the monetary aggregates.
Okay. One last question, and let's throw it open. You've talked about the European problems. The euro is down, Greece is, and I would tend to agree with Bob that they're likely to drop the euro at some point. And clearly the market here is reacting to this. Is this because we're worried about the problems of competing with Europe, with a lower euro, a European recession, or it really is the canary analogy? We're worried about the same types of financial events taking place in this country. Yeah.
Well, the first thing I observe is that we've been there, done that. We have seen what I think is a very similar situation occur in 1997 and 1998 with the Asian economic debacle. Mm-hmm. Very similar circumstances began in Thailand with the breaking of the peg between the Thai baht and the U.S. dollar, but debt was very much a part of, over-indebtedness was very much part of the bubble that just then just continued to roll over Asia. But you look at the results. What were the results in the United States from the Asian economic debacle? Lower interest rates, lower prices. Lower interest rates help the housing industry. Lower interest rates tends to have a favorable effect on stock prices through a discounting of future profits effects. Lower oil prices, because we're a net oil importer, put more dollars in, spendable dollars in people's pockets. So actually in 1998, the U.S. economy had a pretty good year in spite of the Asian economic debacle. I think so. Those are all positive things that you can look at. And right now we're seeing, guess what? Lower interest rates, lower interest rates. The only thing that we're seeing that we're having a difficulty with is the lower stock price portion of this. And then that raises the question that, as you put it, is it the canary in the coal mine? Are people seeing past the Greece problem and saying, hey, is this what's going to happen in the United States?
I think Kent has half the problem. I remember the Asian crisis well. I went to Asia in March of 1997, went to Hong Kong, Bangkok, KL. It was obvious it was a bubble. And I vividly remember sitting at the Red Carpet Club in Tokyo writing emails back to friends in Chicago, and the agency sort of saying there's a massive bubble in the world, in this part of the world. It's going to implode, and it's going very soon, and it's going to lead to a turnabout in our trade balance of 150 billion. That's 3% of GDP, and that's going to have horrendous effects on U.S. manufacturing. I wasn't prescient enough to say anything about Ohio manufacturing. But what Ken has captured is the impact of the money inflows on asset prices, and what he's neglected is the negative consequences of the sharp increase in our trade deficit on employment in manufacturing in Ohio, Illinois, Michigan, and the other states.
Well, it's in terms of trade effect against that effect.